Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Asian stocks extend a global sell-off as worse than expected economic data from the US adds to fears the Fed is behind the curve on rate cuts. European and US futures, though, point higher after last week's stock rout. Deflation risks grow once again in China. Consumer prices rise less than expected as weak demand threatens Beijing's annual growth target. Plus, the race for the White House heats up with another poll suggesting the election is too close to call. We discuss that and Donald Trump's 100% tariff threat on countries that shun the dollar. Happy Monday then. A challenge session over in Asia, but European and US futures, as you can see on the screen, pointing higher after the rout of last week. Of course, losses of more than 4% on the S&P by the end of the week. Losses of around 3.5% for European stocks. And the Nasdaq seeing its worst week since November of 2022. European futures, though, for now, looking to take something of a breather, adding 23 points as we set up for the Monday session. FTSE 100 futures pointing to gains of around 0.7%. S&P futures stateside looking to add just 21 points. Nasdaq futures also in positive territory, up 0.6%. Nvidia, by the way, for the context, down around 20% since that earnings release at the end of August. Bit of selling pressure coming through from the Treasuries market. Again, a bit of a breathing action coming through for Treasuries given the gains of last week, and they were pronounced. Now, modest selling pressure. 368 had the bond market gotten over its skis. Still that debate, of course, as to how far and how deep the Fed is going to go with the first cut coming through. Expected, of course, September the 18th, but markets still divided after the jobs data of Friday as to whether they go 25 basis points or 50. 110 on euro dollar. Brent, 71.96, just shy of $72 a barrel, currently up 1.3%. So a strong session for oil for now. The context, of course, the weakness of last week. And WTI, the last time I checked, was still below $70 a barrel. Iron ore crossed below $90 a tonne. That continued concern around the demand impulse out of China and excess supply around iron ore, currently down 1.5%. So you're seeing divisions in terms of the commodity market and splits, with Brent gaining, iron ore under pressure once again. Let's cross over to Asia right now. Avril Hong standing by for us, of course, in Singapore for a breakdown of the markets there. And it's been a challenge session, as I said, Avril.
Yeah, we saw Asia's stock gauge slumping at the start of trading and to roughly now the lowest level since the middle of August. Asia equities just hit by this wall of worry, economic jitters, not just from the US, but data out of China and Japan as well. And amid all this, we're seeing the tech-driven markets, the ones among the hardest hit. The yen was stronger earlier today. We're seeing that help to filter through into some of the appetite for Japanese equities in a bad way. And the Nikkei was actually down 3% at one point, though it's managed to pare some of those declines. Now, we had the data out of China today showing those deflationary fears persist, given how CPI rose less than expected. We also had deeper contraction on the factory activity front, and then couple that with data out of Japan, which showed a Q2 downward revision on GDP growth. Now, let's flip the board and take a closer look at what we're seeing on the dollar-yen moves, because a lot of it has been driven since last week, of course, from the US data, a bit of safe haven demand. Today, though, we did get data out of Japan, as I mentioned, on that GDP print, something that this is still enough of a rise on Japan GDP to bolster the case for the BOJ to hike rates again. We also had the current account surplus widening, and then the kicker, I think, was from the likes of former BOJ Governor Kuroda, who typically had sounded dovish during his tenure, saying that we are far from the neutral rate in Japan, which suggests we could see a lot more hiking to go. We did see a bit of a giving up of the gains on the Japanese currency, though, not just against the greenback, but also on the Aussie dollar. Let's flip the board because I wanted to take you to some of the key indicators that we are watching really closely as well, including on the cross Aussie yen. It is, as I say, rising today, but if you look at the trajectory since September, it's mostly been downwards, and this is a cross that is typically the primary hedge for risk aversion for investors. So this overall doesn't bode well for Asia equities. Tom.
Avery Hong in Singapore with a deep dive on the Asian markets. Thank you very much indeed. To the US hiring data then, the jobs data, of course, of Friday. Falling short of those forecasts then for the month of August. Fed Reserve Governor, meanwhile, Chris Waller, says the latest jobs data calls for the central bank to begin cutting rates.
Balance of risk has shifted toward the employment side of our dual mandate, and that monetary policy needs to adjust accordingly. The current batch of data no longer requires patience. It requires action.
No longer a time for patience, but a time for action. Mark Cranfield from our Markets Live team standing by for a take on what we've been hearing, of course, from FOMC officials and the data that crossed, the importance of it on Friday. Investors, Mark, didn't seem overly impressed with Waller's comments. What's going on there? How do you tie that into the data that we saw, the FOMC reactions, at least from one speaker there?
Yeah, it's a question of how much action. So you've got a disconnect here between what investors are looking for and what Fed speakers are likely to give them. So after that data came out, investors probably thought that that was enough to satisfy these huge number of rate cuts, which they've got priced into the curve, something like 200 basis points worth of interest rate cuts, including expectations that the first one will probably be a big one, 50 basis points rather than the 25. And yet when the Fed speakers came out after the jobs numbers, they were much more circumspect. They were not convincing investors that, yes, this first move is going to be the big one. And so there was disappointment. Equities sold off again after Mr. Waller spoke on Friday evening. Of course, there's been a little bit of a rebound today, but nothing to make up the kind of losses that we saw last week, which, as you were mentioning earlier, the worst week in 18 months for US markets. So here we are, where we have this situation going in towards the Federal Reserve meeting where investors are looking for something that looks close to a hard landing scenario for the US markets, and the Federal Reserve seem much more relaxed. They seem to be thinking that a slow, soft landing is probably the more likely scenario, which suggests they will discuss 50 basis points, but they're probably leaning towards only doing 25. And for the moment, that doesn't look as though it's going to satisfy the people in the market who are very hungry for a lot more than that.
And meanwhile, we are seeing that relaxed nature that you've pointed to from some of those FOMC officials being echoed, it seems, by the US Treasury Secretary Janet Yellen, speaking to Bloomberg and saying there are no red lights flashing for the financial system. She reiterated as well her view that the US economy has reached that soft landing that you've been talking about, even as job growth weakens. Let's take a listen.
Overall, I would say for the US, the kinds of metrics that we would monitor that would summarize risks, whether it's asset valuations or the degree of leverage, things look good. I don't see red lights flashing.
So, Mark, to give her credit, the Treasury Secretary has been banging the drum, at least reiterating her view that there is a soft landing in the cards for this US economy for months now. And so far, of course, she's been proven right. Will traders take any level of comfort from these comments? Again, reiterating the soft landing scenario for the US.
Probably not too much comfort. I don't think they would have expected Janet Yellen to say anything else, really. I mean, don't forget, she's now in a political post where there's an election coming up as well, and she would probably want to give all the right signals from the point of view of the Democratic Party. So traders will probably look at it and say, well, we wouldn't expect you to be giving us a warning about a hard landing coming when it's your job to tell us that everything is all right. Also, they would look at her track record. When she was chairman of the Federal Reserve, she was probably the most dovish chairman that they've ever had at the Federal Reserve. So I don't think she ever gave any hawkish indications at all in her whole time. Having said all that, of course, she will have respect from people, the fact that she sees a lot of data, she has a lot of experience, and if she thinks a soft landing is coming, then some people will say, well, that's a relief. But overall, I suspect it won't do much to dissuade traders that they expect a lot of interest rates to come and they would like the Fed to get started with a bigger one rather than a smaller one. Having said that, Janet Yellen is not on the Federal Reserve Board this time around, so it's somebody else's job to do it. But traders overall, for now, they still think it'd be better to get the job started because they missed in July. Some people are thinking they should have already started lowering interest rates there. Better to kickstart with a bigger one now rather than wait till later in the year.
OK, and we'll continue to watch how the markets readjust to that view. Mark Cranfield from our MLive team with the analysis. Thank you, Mark. Now, China's consumer prices rose less than expected last month. That is a familiar story now, isn't it? Adding to signs that policymakers are still struggling to get households spending. Let's get the details and bring in Bloomberg's Min Min Lo, who's standing by for us in Hong Kong. Min Min, what does the data tell us then about this struggling economy?
Yeah, you're seeing both CPI and PPI missing expectations here, and you're really getting a sense that weak domestic demand is also underpinned by this excess capacity across the industrial sector there, because you have headline CPI 0.6% year on year, but that really masks the underlying weakness in demand, because remember in August we have bad weather that really boosted vegetable food prices, and if you strip away the food and energy prices and look at the core inflation, that actually turned negative for the month of August to negative 0.2 compared to the previous month. And then you look at producers' price index, that's really steep in deflationary territory for the 23rd month now, and again driven by broad weakness across commodity prices, for instance. And you have the former PBOC Governor Yi Gang saying last week at a financial conference in Shanghai that the government really needs to pay attention to inflation as a target now. China's inflation target is 3% this year, and it's not really talked about. The government has really been prioritizing the growth target, but Yi Gang is saying he's hoping that the GDP deflator turns positive by the end of the year, but that's looking very challenging right now.
Yeah, as you said, really fascinating to hear from the former PBOC Governor Yi Gang. It's not often that you hear forthright comments from former senior officials, of course, in China, speaking at the Bund Summit. Meanwhile, the big policy question in terms of stimulus that, of course, some have been itching for, it's not forthcoming. It doesn't seem like it will be. Why?
Yeah, I mean, we have already seen this drip feed of positive of stimulus on the demand and supply side, but the policymakers' mandate is very clear. They are supposed to hit that growth target of around 5%, and they've given themselves a bit of a wiggle room with that qualifier of around 5%, so slightly below that is still acceptable. And the government has repeatedly signaled that they're in the process of restructuring the economy. They are shifting towards this high-quality growth, high-end manufacturing, and in the meantime, they're willing to tolerate slightly slower growth while they fix some of the fundamental issues there. There's so many other competing priorities right now. They're trying to decouple the property sector from broader consumption. They're trying to reduce local government debt, and they're trying to clean up the financial sector, for instance. So it looks like we're set to trudge slowly and surely towards close to that 5% target. 4.8% is the consensus among economists right now. Unless there is perhaps extremely weak data that comes out in the coming months, then maybe the government may consider something that is a lot more aggressive to act as a sort of circuit breaker for the economy.
OK, trudging towards 4.8% in terms of the growth for China. Min Min Lo in Hong Kong with the latest in terms of what this data tells us about the challenges facing the world's second largest economy. And you talk about China, and you cannot talk about China without talking about what's happening in commodities. And again, a remarkable story coming through, given what unfolded last week, the pressure on the oil space. A bit of relief right now in oil. And again, there's a split between the moves in the oil markets versus what's happening in terms of these core inputs around iron ore and copper, particularly around iron ore. But let's start with the oil story. We're expecting to get reports from OPEC, from the IEA, 3, in fact, reports in terms of the oil space this week that could give more details. Deep concern, of course, about the demand surplus and supply balance, I should say, demand-supply balance around oil. China, again, part of that factor. Still below $70 a barrel on WTI, but seeing gains of 1.3%. Brent is also up in the session, solidly a little over 1%. Iron ore, very different story. It did cross below $90 per tonne. Further pressure again, down 1.4%. China is facing a steel crisis. And, of course, the demand picture out of China, as a result, is looking much softer. So we continue to watch pricing around iron ore and how that turns and ties into basic resources and the miners as well. Copper, 8,994, currently flat. Talking of commodities and the analysis in that space. Coming up later on The Pulse, Carlyle's Energy Pathways Chief Strategy Officer, Jeff Curry, is going to join the show. Don't miss that conversation on oil and the wider energy sector just after 9 a.m. Where does Jeff see these prices going in the weeks and months ahead? Talking of what's ahead, here's what else to be thinking about then today and leading up through this week. Tuesday, in terms of the US political calendar, this is the big one. The presidential debate, of course, between Kamala Harris and former President Donald Trump, as the polls suggest, a very, very tight race. Wednesday, then, it's the inflation data out of the US, arguably less important now than the jobs data, given where the focus of those Fed officials is, but still, of course, consequential in terms of thinking about how far the Fed's going to go with its cutting cycle. Thursday, it's the ECB rate decision, with markets pricing in another 25 basis point cut. Any commentary, of course, from Christine Lagarde will also be scrutinised. Coming up, with less than 2 months then until the US election, another poll puts the result within the margin of error. We bring you the latest next, and we will have an exclusive interview with Laura Connell from Atomico to find out why her firm is investing billions into European tech. Stay with us. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Happy Monday. Now, Republican presidential nominee Donald Trump leads Democratic contender Kamala Harris by 1 percentage point in a poll taken late last week. It's just the latest sign that the race is too close to call. Let's get more then with Bloomberg's managing editor, always smart on US politics, Derek Woolbank. Derek, has then Kamala Harris the enthusiasm, the optimism that we saw leading up to the DNC, through the DNC, has that optimism, that momentum now peaked for the vice president?
Well, Tom, what we've got right now is we've gotten a pause in the expansion of support for Kamala Harris. It's sort of hit a level, and part of the reason that it's hit that level is because Donald Trump's support hasn't really budged too much. He has stayed in the upper 40s, depending on whatever survey you want to look at. Harris has moved up into this tie with him, but has not been able to break through from there. Right now, if you look at this New York Times poll that has just come out, you've got Trump up 1 nationally and across all of the swing states. According to the New York Times' state polling average, you're seeing exact ties near about in Nevada, Georgia, North Carolina, and Arizona, and very bare Harris leads in Wisconsin, Michigan, and Pennsylvania. And all of that says that walking into this week's debate that you rightly previewed, we are looking at a very, very close race for the White House and all that comes with it, with 8 weeks to spare.
Yeah, that debate is going to be fascinating, isn't it? And things could, of course, move on the back of it. Meanwhile, Trump making some news again, drawing some headlines, pledging 100% tariffs for countries that shun the dollar. How serious do you think the Trump administration is about this threat?
I mean, I think they're serious as a heart attack. I think people, look, Tom, you and I have covered this for a good long time, right? And you have a lot of Asia experience here. And you and I were both around when Donald Trump was talking about tariffs the first time round, and people thought, oh, well, he's probably kidding or he's probably bluffing. And he went and implemented them, right? He went and put in a bunch of tariffs. And this is a sort of thing that when you're looking at Donald Trump and you sit there saying, oh, well, you know, Democrats in Congress may thwart. You didn't need Democrats in Congress or anybody in Congress because tariffs is one of those things that a president can just go and do, right? So when Donald Trump is talking about tariffs, you do have to take it seriously because he does have a record as a former president of having used tariffs among the U.S. economic arsenal quite prolifically, right? I do think that this idea of de-dollarization more broadly is something that the United States is paying attention to. It is something that is resonant. The idea of whether or not the U.S. dollar is strong is a resonant idea. Although, interestingly enough, Donald Trump has talked about wanting to eventually lower rates during his presidency, upcoming in his mind, and sort of make the dollar maybe not quite as strong as it is right now. But the idea of the dollar as a global backbone of the financial system, I think it's resonant on both sides of the political spectrum, as well as the electorate, both the sort of prestige there, but also the kind of structural advantages you get when you have that reserve currency status. And all of the time that there's noise about maybe that is under threat is something that the U.S. government will take seriously, no matter who is in the White House. But you certainly, as I say, you certainly hear Donald Trump talking about the possibility of penalizing there. I wouldn't rule that out just because people want to, maybe take with a grain of salt what he says.
And we'll see if he builds on that in this upcoming debate, to which many people will be tuning in. Talk to us about how significant this is. I said the Trump administration, of course, I meant the Trump team in terms of these tariffs. When it comes to the debate, how significant, how pivotal could this moment be?
Well, Tom, it's interesting. I think had you asked me in, let's say, May or so about how significant the debates were going to be between Biden and Donald Trump, I would have told you about how usually debates come and they go and the race continues on apace. Obviously, the debate between Joe Biden and Donald Trump was transformative, and we're looking at what may be the only real chance to see Kamala Harris and Donald Trump together. One of the things we are seeing in that polling we mentioned early is that people have a really good idea of who Donald Trump is, what he would do. They've seen 4 years of his administration. But Kamala Harris in some ways still has a bit of an unknown. The Trump campaign is trying to define her as this sort of San Francisco Bay Area liberal. Harris in practice is maybe a little bit more towards a pragmatist than people sometimes give her credit for, and certainly more than she was running as the last time that she ran for president. So this is going to be a real chance for Harris to define herself. And the other thing I would say, Tom, is you're hearing the Harris campaign start to lower expectations, but this is someone who came out and said, I'm a prosecutor, he's a felon. And in those sorts of contrasts, you would expect a former prosecutor who has done very well in debates in the past to have a pretty good night. Of course, Donald Trump has been underestimated on that debate stage more than once.
Well, that is true. Bloomberg's managing editor, Derek Allbank, setting us up very nicely indeed for that crucial Tuesday debate out of the US. Plenty more coming up. We'll have a focus on geopolitics, including Israel, Ukraine, Russia, and Venezuela. Stay with us. This is Bloomberg. Now to some other stories making news this Monday. A gunman has killed 3 Israelis at a terminal on Jordan's border with the West Bank, the first such incident since the war in Gaza began. Israel's army says the gunman accessed a bridge crossing from the Jordanian side in a truck and fired shots before he was killed. Israel closed the crossing while checking the truck for explosives. 2 NATO members reported incidents involving Russian drones over the weekend as Moscow steps up its missile and drone barrages against Ukraine. Latvia's president said a Russian military drone crashed in the eastern part of the country on Saturday. Meanwhile, Romania's foreign minister issued a statement urging Russia to abide by international law after a drone violated its airspace over the weekend. Venezuelan opposition leader Edmundo Gonzalez has been granted political asylum in Spain after fleeing his homeland to avoid arrest. It comes a month after the opposition presented voting records they say prove Gonzalez won the July presidential election. And the French government has requested an extension from the European Commission to the deadline for submitting its plan to reduce the public deficit. The Finance Ministry told Bloomberg it asked for additional time to ensure consistency with its 2025 finance bill, without saying what the new proposed deadline would be. Coming up, the ECB poised to cut interest rates on Thursday in a warm-up act for the Fed. We bring you the preview and the analysis. Stay with us. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie here in London. These are the stories that set your agenda. Asian stocks extend a global sell-off as worse than expected economic data from the US adds to fears the Fed is behind the curve on rate cuts. European and US futures though point higher after last week's stock rout. Deflation risks grow in China. Consumer prices rise less than expected as weak demand threatens Beijing's annual growth target. Plus, the race for the White House heats up with another poll suggesting the election is too close to call. We'll discuss that and Donald Trump's 100% tariff threat on countries that shun the dollar. Let's check in on these markets today when the dollar is bid modestly up about 0.1% the last time checked on the Bloomberg Dollar Index. On the European futures setup, though, a little bit brighter is the mood coming through after the rout of last week. European stocks ended last week down 3.5%. European futures now pointing higher by 0.5%. The FTSE 100 here in the UK looking to add 52 points, up 0.6%, despite further weakness in the iron ore space that could weigh on basic resources. S&P futures then looking to add 20 points, up 0.4%. The S&P closed lower by the end of last week by a little over 4%, and the Nasdaq saw its worst week since November of 2022. Looking to add 104 points so far, though, pointing higher by 0.6%. Let's flip the board, look cross-asset. Bit of selling coming through for US Treasuries after the bond bulls had the bit between their teeth firmly last week. So far in the session today, rewinding, unwinding just some of that around the margins. Yields up 4 basis points at the front end, 369 on the 2-year. Still debating, of course, how far the Fed goes on September the 18th, 25 or 50 basis points. The market's still undecided. Euro-dollar 110, Brent $71 a barrel, 71.90, up 1.2% so far in the session. A little bit of upside coming through after a challenged week for oil last week. Iron ore, $90.55 a tonne, down 1.2%. Now to the ECB and the Eurozone. Mario Draghi set to deliver his long-awaited report on European competitiveness today. The former ECB chief expected to sound the alarm over the risk of the EU's economic decline. Joining me now is Jamie Rush from Bloomberg Economics, with a finger on the pulse, of course, of the data and the evolving economic situation across the Eurozone. Jamie, what are you expecting Mario Draghi to say ultimately in this report?
Morning, Tom. Well, look, this isn't the first report we've had like this. I remember the last one we had was in 2003 by Andres Sapir, and he said back then that it was as if Europe is stuck in a rut. And the fact is that we've been stuck in that rut for the following 2 decades. So I think Draghi is going to highlight that fact that the economy has been falling away relative to peers like the US. There's now an 18% roughly GDP gap with the US that's emerged over that period. And so he's going to flag that this is going to be a serious risk for the Eurozone. It's going to change the Eurozone or the EU's standing in the world if it continues. I'd expect him to flag that there's a need to invest in critical sectors like energy, like telecoms, defence, and a more active, and probably call it a more active strategy when it comes to dealing with subsidies from China, from the US. Where is the EU positioning itself in that? The main problem, of course, is that there's no money to finance any of this. There's no fiscal space in the Eurozone and in most economies. He's going to call perhaps for joint borrowing, but I think that's dead in the water ever since Macron was weakened by that election result this year. He was the main champion of joint debt, and it doesn't look like Germany are going to get on board. So there's serious problems with whatever even Draghi suggests is going to be difficult to tackle.
OK, so the fiscal constraints of the Eurozone are there, the domestic politics as well. Does the ECB ride to the rescue, Jamie? Markets now expecting a cut, of course, this week from the ECB, the second cut of the cycle. What's changed for the Central Bank of Europe since July?
Tom, the ECB has always come to the rescue. There's no other functioning institution in the Eurozone. That's what some people say. So I think what's changed, frankly, a couple of big things have changed, of course, since the July meeting. We've had Jackson Hole in the US, where the Fed has now signalled that it is time for cuts. So there's now confidence that that cutting cycle is commencing, and that takes some pressure off the currency. So it makes the ECB's job easier. It makes them more comfortable to cut interest rates through that channel. Also, they've had a comprehensive measure of wage growth in the Eurozone. That landed last week. It's compensation of employees. It really does capture everything that's going on. And we've seen that that's fallen back to 4.3% on the year, much below what the ECB was forecasting, which is 5.1%. So that, again, is giving them confidence in this disinflation narrative. And also we saw that profit margins are also starting to fall back a bit as well. So there's lots of good positive news for the ECB, which is going to allow them to start cutting it, well, keep cutting.
OK, Jamie Rush, Bloomberg Economics, on what to expect from Mario Draghi and the setup for that ECB decision. Jamie, thank you, as ever, for the analysis. Let's get more insight right now and bring in Sophie Huynh, Senior Cross-Asset Strategist at BNP Paribas Asset Management UK. Sophie, good morning. Given the challenges faced by the Eurozone, we think particularly of Germany, of course, and then the politics of France, are the markets underestimating how fast this ECB is going to have to move?
I think the ECB cutting cycle has started, but I think the question you asked earlier on what changed, I think it's quite conditional at this point on how fast the Fed and how, like, whether or not we're going to have jumper cuts or not. So it's very conditional on the Fed, but it's clear that the ECB is here to support the market. But one thing to keep in mind is the bar on Europe is quite low. I mean, the expectations are so bearish. At a time where, if you look at the consumer balance sheet, it's much healthier than what it is in the US.
Well, that's interesting. So that suggests that you're relatively constructive on European equities. What, they're up around 6% year to date. They took a big hit last week, down 3.5%. If you are constructive on European equities, where is your focus at this point, Sophie?
So I think it's something we've been saying for like a couple of months now, where where we see the equity allocation and where we are at the stage of the cycle. You had a chunk of crowded trades, and the current environment has been calling for a reassessment of how much risk and the nature of risk you have been taking in portfolios. The NVIDIA result basically, I think, gave the green light to rotate out of this mega cap into cheaper parts of the market, so the rest of the S&P. But I think European equities and Asian equities, from a relative perspective, could fare quite well, not because the bar is low. In terms of earnings expectation, is quite low. But I think the wild card is definitely China. So in terms of where you want to allocate within European equities, I think French equities or German equities could make sense from that standpoint.
OK, so German or French equities could make sense, despite the fact that you're highlighting China as a wild card. Is that China as a wild card to the upside if stimulus comes through? How are you thinking? What is the rationale for getting exposure to either Germany or France, given the demand that's needed for many of those manufactured products, whether it's luxuries or autos, out of China?
So I think one thing to keep in mind is, so if you look at French equities, you still have this political premium. We didn't have the catch up that a lot have been expecting. Yes, there's still some political uncertainty, but at this stage of the cycle, when the dollar is going to be weaker, you're going to start scrambling for cheap parts of the equity market. And I think these two parts are going to benefit from it. On the China side, given the current data, so this morning, the CPI, I think one thing to keep in mind is if they want to reach the 5% target this year, it means that they will have to react soon. So boost consumer demand. It's clear that consumer sentiment has been on a declining trend over the year. They will have to do something, not only in terms of like stimulus on the consumer side, but as well a bit more good news as on the property side as well. And this in itself is going to be quite positive for like European names.
And Sophie, you say that there's further to go in terms of unwinding US exceptionalism. How do you play that within the FX space? Is that a short dollar call? And if you're going short the US dollar, what's the cross, the favored cross?
So I think US exceptionalism is still embedded into a US asset. It's quite clear there. The fact that the economic surprise indicator in the US has been negative for a while, it's not coming as a surprise. But to some extent, US resilience is still into the prices. So I think one way to play it is to be short the dollar. One pushback you could give me is, well, what about the dollar slide? But I think the positioning on the dollar is still still so bullish that the Dixie at 90, unless the Dixie goes back to 95, the dollar smile is going to be crooked from here. And one way to play the short dollar play is basically a long yen. Or if you want to sprinkle some risk into your portfolio, we think that having some high beta currencies such as the NOK, the Swedish krona, or the Kiwi or Aussie could make sense.
OK, looking to the krona, the Kiwi, the Aussie, and going along the Japanese yen. Sophie Huynh, Senior Cross-Asset Strategist, BNP Paribas Asset Management. Thank you for that take on the back of the US data. Looking ahead, of course, to the ECB and how to position in these markets. Coming up, betting big on European tech, we're going to be speaking to Laura Connell from Atomico next to find out why her venture capital firm is investing billions into Europe's next game changers. They have raised a sizable raise, about $1.2 billion US. We'll talk about how the firm plans to deploy that capital. Stay with us. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Happy Monday. Now, big day for Apple with the iPhone 16, the tech giant's first AI-focused smartphone being unveiled later today. Apple also the focus of our big take today, which takes a look at its rise to become the world's most valuable company. Let's bring in Matt Bloxham then, Senior Tech Analyst at Bloomberg Intelligence. And we'll start the iPhone 16, what to expect, particularly with the AI overplay. Matt, what are you looking for? How consequential could this be for Apple and what it tells us about their AI ambitions?
Yeah, I mean, I think we kind of heard about their AI ambitions back in June with the big announcement there. So I think in many ways, this might be a little bit of a kind of underwhelming launch, if you like, because the phone's going to look very much like the 15. And so it's going to be a kind of a platform for these new AI features, but a lot of those are being pushed out. So it's going to be interesting to hear today exactly how hard they push the AI features, given it's going to be at least until October when the OS 18 software update comes out, and then all of the features rolled out late this year and into next year. There's a few other things coming with the device, like action buttons across all of the devices, and a new capture button, which is a bit like having a kind of capture button on a digital camera. So that's going to be interesting. We'll see how much they kind of push that as a kind of novel new feature that might kind of think, actually, you know what, I'm going to kind of upgrade to that new phone. And the Pro and Pro Max models are going to be slightly bigger. So, you know, I think no overwhelming updates in the kind of form. They definitely will push the AI features, but it may well be that it's kind of delayed excitement from the consumer, given that a lot of these actual features won't be accessible for a few months.
Is it enough? Oh, you touched on it. Is it enough to power an upgrade cycle? That's what they're looking for. That's what they need. And what's the competitive threat out there now?
Yeah, I mean, Huawei's launching some new handsets soon. You know, there's lots of competition out there, but I guess really you've got very much a kind of Android camp and an iPhone camp, and I don't think they're going to see too much kind of shift either way with this particular launch. You know, I think everybody's looking for a super cycle. I don't think you're going to get that in the next quarter or so, but maybe as more of the AI features become launched in the next few months and the consumer kind of gets to understand what they can do for them, then maybe into next year and perhaps even with the iPhone 17 in a year's time, that's where you start to kind of get more of a potential for a big super cycle. OK, Matt Bloxham from Bloomberg Intelligence setting us up for what to expect from the Apple iPhone 16 update, I should say, coming through, and what we're going to hear about AI as well as they build those services and software onto those hardware platforms. Matt, thank you very much indeed. Let's stay focused on technology, but zero in on what's happening in the European tech space right now. One company looking to turbocharge the sector, Atomico, the VC founder, of course, and VC firm, I should say, based here in London, has this morning announced it has raised $1.24 billion US, little over $1.2 billion, for its two new funds, which will assist some of Europe's most brightest prospects in terms of the tech space. That is the hope, at least. Joining us now for an exclusive interview is Laura Connell, who is a partner at Atomico. So the funds split. Good morning, Laura. Thanks for coming to the studio.
Good morning. Thanks for having me.
Split between an early stage fund and a growth growth fund. The growth fund, really interesting. We know in Europe there's a lack of growth funding, so we'll talk to you about that. But broadly, what does this tell us about the fundraising environment right now? How much of a challenge was it to raise this capital?
Yeah, I think, look, there's no getting away from the fact that it's been a challenging fundraising environment all round in the US and Europe, and indeed on a global basis. But what we're very pleased to have seen with this fund is that we've actually raised 2 funds that cumulatively 50% larger than our last fundraise in 2020. So, to your point, a real endorsement of the appetite and the opportunity that the underlying investors see, both at the early stage and at the later stage. I think the other thing to say about it is, we think about some of perhaps the structural gaps and opportunities more broadly in tech and tech investment in Europe. Something that will be discussed as part of the Draghi report, no doubt, is this liquidity and capital gap at the later stage, the growth stage, where to throw a few stats your way, around 40% of, there's a smaller opportunity for early stage companies, 40% lower probability of early stage companies raising a following VC round 5 years after their initial investment versus their US counterparts in Europe. Conversely, actually, we find that those companies that have raised a seed fund in Europe have the same probability of getting to $1 billion valuation as their US counterparts. So, it's not a question about the quality of the opportunity. It's just really there is this liquidity gap that we're seeing that hopefully will be part of addressing.
Okay, so you're hoping to close that gap partially with part of this fund.
Yeah.
What are you hearing for more LPs in this environment? Is there more caution there? Is that why you've got this appetite for growth? It's slightly less risky part of the ecosystem versus early stage and seed. And if that's what you're hearing, does that continue? How does that continue to evolve, that story?
Yeah, so interestingly, around 75% of our LPs actually re-up their commitment as part of this fundraise. So again, testament to the trust they have in the opportunity, both across venture and growth. I think it's the growth opportunity and the fact that many VCs raise a growth fund subsequent to having raised a venture fund is more so that you can see the opportunity to double down and work with the best founders over the life cycle, and that really, given the distribution of returns, you want to have that flexibility to support them as they grow. As the real distinguished opportunities come through with the best founders in the venture fund. I think so therefore it's not so much about kind of lower risk because really we're in the business of working with founders who want to build kind of category defining companies and therefore are taking a huge amount of risk by definition, but more so making sure they've got access to the capital at every step of the way.
So what's standing out to you right now, just for the viewers, for the context? Atomico has backed companies like Klarna, like Supercell, like Bird and Stripe, so some really big names and some that will be coming to the public markets, you would expect, in a relatively short space of time. What is drawing your interest right now? Where are you putting this money to play? You're a generalist firm, but what's standing out to you in terms of the opportunity? Yeah,
absolutely. I mean, I think what we're really trying to do is work with those game-changing founders who, as I mentioned, are trying to build category-defining companies and solve really hard problems. Now, what does that mean? I think you can see some fundamental structural trends across the OECD, namely declining factor productivity and the like. So what we're really trying to address, if you want, with the founders that we work with, is how to get at some of the kind of biggest levers for growth, some of the biggest opportunities we see really tie quite closely to those productivity measures, be it industrial automation and the like, or even energy efficiency and climate tech together with financial efficiency, and of course, driving human capital. So many of the investments that we've made really seek to address those problems across each of the factors of productivity that we have. And then, of course, you have some kind of second order, and if you like, the kind of second differential, i.e. those solutions that help those front-end solutions to grow as quickly as possible, like artificial intelligence, like data and automation, and we really try to get as much exposure there as possible and work with the greatest founders there.
Has Gen AI, has it sucked the air out of the room in terms of the flows? Is there a blind move into Gen AI, or is that opening up opportunities that are being overlooked? Yeah,
it's such a great question, because I think with every new technology shift and kind of paradigm shift, which you really have here with generative AI, you often go through this hype cycle, and there's no question that we have been deep in the hype cycle here. But that being said, what's been very heartening to see now is that we've seen the kind of broader adoption of generative AI across all the companies that we work with, as you'd expect to see with, as I said, this kind of paradigm shift in the kind of technology that founders are able to work with and really integrate into their core solutions. So, yes, we were initially in the hype cycle. I think it's fair to say that you could see some of the valuations and the amounts of capital that have gone into generative AI, but there are some real kind of clear productivity gains to be had with this technology, and not least, some of the news we've seen out of Klarna and real applications here that will change the way we work.
OK, Laura, thank you very much indeed. Laura Connell, partner at Atomico, raising $1.24 billion in 2 funds, early stage and growth. So we'll continue to watch that VC firm in terms of how they deploy that capital going forward. Plenty more coming up. Stay with us. This is Bloomberg. Welcome back. You are watching Bloomberg Daybreak Europe. Happy Monday. Let's reflect on what happened in terms of the non-farm payrolls, the jobs data of Friday, before we move you forward and look at the inflation preview out of the US. Yes, our eyes are still, of course, on the US data. The breakdown in terms of the jobs data then. Services and government jobs actually expanding. Here's where the pressure came through in a top-line jobs print that came in below the estimates. Of course, it's manufacturing. That's the blue segment of that bar, contracting in terms of manufacturing jobs. And we've seen the PMIs in the manufacturing space contract, haven't we? The divergence between services and manufacturing, and you're seeing that reflected in the jobs data. Remember, of course, that the expectations were you get a print of around 165,000. The whisper number was around 140, and that's essentially where things landed. Unemployment, the rate moved from 4.3% to 4.2%. But again, it was a miss in terms of the overall non-farm payrolls number. And then you had some FOMC members like Chris Waller suggesting they're not in a rush to go 50 basis points. 25 basis points, yes, that is priced in by the markets come September the 18th. But if you're expecting that 50 basis point cut, maybe if you've been listening to Chris Waller, you'd be a little disappointed on that fact. Yields are up today. Markets expecting pricing in around 31 basis points. It's still divided on that question come September the 18th. Let's flip the board and have a look then on those market expectations, because if you look out to July of 2025, you're actually looking at markets pricing in over 220 basis points, so more than 2 full % being priced in by the markets into next year. Are markets getting over their skis? Where do you land in terms of the debate that's shaping up for these bond markets? Do you want to be getting exposure to the front end of the Treasury market, given the work that's been done, the moves into that part of the curve last week? Yields up again, just moderately in the session so far. Let's think about the pricing then and where that leaves us before we lead into the CPI print. And we know, again, the focus is more now on jobs than inflation, but nonetheless, the expectations. So this is the move. Chris Waller, that comment around data requiring action, but don't see the US headed for recession. And that was echoed as well by the US Treasury Secretary Janet Yellen, saying she doesn't see any red flags in the data right now. Let's flip the board and look at the preview then for CPI. That number drops on Wednesday. Expectations of a print of 2.6% year on year versus 2.9%. Again, consistently, you've been hearing from FOMC officials that they are becoming more comfortable with the sustainable nature of the move closer to that 2% target on inflation. And a number of FOMC officials have said for them, the focus now has shifted from inflation to the jobs data. Later in the Pulse, the former CEO of Legal & General will discuss the Wilson report. That's at 9:40 a.m. London time. The opening trade, though, is up next, walking through these market moves. Stay with us for the expertise. That's coming up. This is Bloomberg.